So this is the portfolio allocation panel. I'm really excited about this panel because we have theory as a professor in Thalia. We have Anjun, who is a practitioner, and then I am an asset owner. So between the three of us, we really run the spectrum of the sort of finance industry from theory to practice and asset owner. So you should get a wide spectrum of how portfolio allocation really applies to all three of us. So why don't we just do our little introductions, and then we'll start with our first question. So Thaleia, do you want to go first?
Yeah. First of all, thank you very much for coming to our panel and to our meeting today. So I am an academic. I have always been an academic. I was one of the first two PhDs in mathematical finance in almost 30 years ago. So in terms of diversity, we were very well. We were 50% because we were only two. And I have observed, I have followed the evolution of the field, and we can talk about this later. I have always worked on stochastic optimization and portfolio management, and this is my area of expertise. So I think that's okay for now. Then we can ask Anjun.
Sure. Again, thank you all for coming. My name is Anjun Zhou. I work for Mellon Capital. Previously, I had a PhD, so I share a little bit of the academic side, but quickly got into industry because I just feel like that's where my mind is. That's where my practical side of me would tell me to go to. So having been to a few places, and right now heading up the multi-asset research group, working on both top-down and bottom-up quantitative trading strategy, research, and portfolio management. Sam?
And I'm Sam Foster. I do not have a PhD. I have instead an MBA. And I work at USC. Yes, I realize I'm on campus at UCLA right now. So I work in the endowment, which is the investment office of USC, and we help run the endowment pool and a couple other pools of capital for the university. So the office is the fiduciary for the university. So then, how does this panel relate to all of us, right? What is portfolio allocation, and why are we sitting here in front of you? So portfolio allocation can mean a lot of different things to different people, and we're all going to go through how it applies to us, and why we're sitting here. So, Thaleia, do you want to go first?
Yeah. So for the mathematical finance community, portfolio allocation basically is a very abstract stochastic optimization problem in which we have pre-specified asset returns. We don't worry about how the market dynamics have been determined. We have a criterion that is also quite abstract, is what all of you know as utility function. And the objective is to solve this problem, which means you have a stochastic optimization problem and you want to find the optimal controls, and the optimal controls are the portfolio strategies that we are looking for. As mathematicians, we care, as you know, a lot about whether the problem makes sense, the mathematical problem makes sense, where there is existence and uniqueness, and how smooth the solution, so on and so on. In my view, these are excellent, very tough questions. It's an extremely interesting area of research. However, I believe it is quite remote from what happens in practice. And I very much hope that this panel will give the opportunity to expose the big gap that we have between the industry and this part of mathematical finance. Yeah.
So that's a good segue into, on the buy side, as I think Tanya mentioned earlier today, we're focusing more on the practical side of buy side, which means the asset management side. And within the asset management, really the whole complex, there are quite a few divisions. But if you think about broadly, asset allocation and portfolio allocation for quantitative firms such as Mellon Capital, the way we think about it is just to look at the underlying market, right? So traditionally, we look at stock portfolios. You can have 2,000 stocks to think about how to construct a portfolio to achieve your target return and with certain risk parameters in mind. And from the top-down perspective, we have, for example, you got stock versus bonds, commodities, and cash. How do you allocate across these 4 asset classes, in that particular situation? Or from the top-down perspective, you think about cross-country equities, right? Equity indices to represent underlying countries' equity index. How do you, again, construct a portfolio to achieve your target return with certain risk in mind? So that portfolio allocation problem for us is to use some kind of a mean variance approach by identifying the expected return for the underlying market or asset, right? Whatever you're thinking, either stocks or credits or countries or asset classes. And with the underlying market's risk in mind, and also the correlation matters, so we're talking about covariance. And also there are all these constraints, either by applied, demanded by clients, or there will be some self-imposed constraints so that it would generate some portfolio that will be somewhat balanced. And with the transaction cost in mind, right, we talked about this last panel, all of these will be coming into this one machinery to go through the optimization, and then we will solve that, generate some optimal portfolio. So that's in the nutshell how it works. But I'm sure Sam would have a different, in Sam's world, it will be a somewhat different application.
It is. It's very, it's not very different, but it is different. So you can see from just how this conversation is going that we've gone from theory to practitioner to asset owner. So the endowment is, as Anjun said, a very complicated multi-asset class problem to solve. And we also use an optimizer, like Anjun described for Mellon. We also have expected risk and return targets for each of our underlying asset classes, and we have a correlation matrix. We then pop it into an optimizer. I say pop it into an optimizer, but you can build an optimizer in Excel these days. So, so you can pop it into an optimizer and get your beautiful efficient frontier, and then you can pick where you want to be on your risk and return allocations. So that's kind of how our overall process works. The underlying asset classes for the endowment don't change that often. The expected returns also don't change that often, neither do the correlations. So there are very small tweaks that happen over time. It's very much like turning a super tanker out in the ocean. That said, what does the optimizer not do? It definitely doesn't take into account the real world concerns of liquidity that we have at the underlying funds. So, I can put in a target asset class return for private equity, but an individual private equity firm might have a 5 or 10 year lock. So understanding within each of those asset classes.
Maybe you should just explain what a 5 or 10 year lock means.
Okay, a 5 or 10 year lock means that you commit to a firm and you will not get that money back for 5 or 10 years, depending on the legal terms of the fund. So it can be a long time horizon is what I'm trying to get at. So so the sort of theoretical approach of constant trading, constant price, knowing the constant price, basically knowing all of the data that goes into the equation continuously and smooth does not happen at the scale that generally occurs at the endowment. So that's definitely one problem that from a practitioner side is very different from the theoretical side. Do you guys have any comments about each other's, how it happens? I would say that the other thing that we do with the endowment, very similar to what Anjun said, is one of the things that I'm responsible for is helping to pick the funds or the managers that the endowment invests in. So I would look at a firm like Mellon and say, what did they do and how did they do it? And so just because I have a particular problem to solve with the endowment doesn't mean that or it means that I have to know how other people are working in the world. And so knowing enough and being able to ask enough questions to ask a bond manager or a quant equity manager how their optimization runs and what their portfolio process is like is also extremely important for me. So, okay. So what about this gap between what we just mentioned across the three of us? It does seem like there's a big, broad discrepancy between where Thaleia sits and where I sit. So do you want to talk about that?
Yeah. Well, I think there's a long history to it, and also there are many reasons. And let's not forget that mathematical finance started primarily with problems in derivative pricing, and these problems were by nature way much more quantitative, and they many mathematicians became interested in this field because they were questions like solving linear equations, numerical solutions, computational methods, and there was a very strong appeal to applied mathematicians for this. So this was one group of colleagues who got interested in the field. Then we had the theoretical developments that were related to the construction of the arbitrage-free pricing theory, and for probabilists, applied probabilists, this is that's a masterpiece of where probability and stochastics and finance, economics get together. So we were fascinated by this, but this was again more towards primarily towards the derivative side. When you look at what happened in the portfolio construction direction, we started with what we call the Merton problem, and we stayed with it. Basically, we started analyzing it in more and more and more complex environments, settings, and because in very arbitrary market frameworks, there is a very strong connection with elements from arbitrage-free pricing theory. I don't want to become technical, I just want to highlight that methodological approaches we used in optimal portfolio, theoretical optimal portfolio models were very close to derivatives through duality. So we tilted a lot towards derivatives, no matter how you look at it. And gradually, the portfolio theory within mathematical finance became more and more and more isolated. It is extremely advanced at the theoretical level. We can analyze any market you give us, any semi-market market, but it is very far from reality. This is one reason. The other reason is that from what we know, portfolio construction in practice comes down to a quadratic optimization problem. So we have the Markovich approach, we have the Black-Litterman approach, there are certain approaches that, at least at the scientific, theoretical level, have not advanced much. And this has somehow discouraged mathematicians looking into them.
And how much of the work that's currently done on the academic side is using the real, live, dirty data sets that if you're running the endowment, as you said, you can look at what an optimizer might tell you to do with a continuous, wonderful data series, but the reality is that the transaction costs of turning the tanker around, or of even being able to get money out of some of the more illiquid investments that you have, are huge constraints on being able to optimize. So how much of the academic world actually digs into how do we apply these theories that we've advanced as far as we have to these dirty realities that we live with when we're actually out there trying to implement them with real dollars?
Are you asking me?
Yes.
Yes. I would say at the worst, epsilon, at best, 2 epsilon.
Oh my gosh, that speaks volume, right?
This does not mean that the academic community, for example, in business schools, has not contributed. In my view, they have contributed much more than we have. On the other hand, we have the ability, we have the potential of contributing a lot if a very constructive dialogue starts.
Right.
This is what I very much believe.
Right.
Yeah.
One of our missions today.
Yes, this is one of our missions today, is to start the dialogue. Yeah.
I'm so familiar with all the terms Thalia just mentioned. Actually, for real, just tell a little bit my personal story. When I was working on my PhD, I got enrolled in economics. And a few years down the road, somebody said, well, why don't you transfer to finance? Great, so finance, to me is closer to my heart. It's all more applied. Still, I was still more on the little bit theoretical side. So, but still, I'm just trying to struggle in between this, theoretical side and practical side. And at some point, somebody said, well, you want to go to Wall Street. I said, okay, great. So where, how do I get there? So they said, well, okay, so over there, at that time I was studying, finance, right? So investments. Somebody said, well, this, for you guys, if you don't know, don't worry. Okay, Fitzgerald Morton framework, right? Very, very popular. So that's for Wall Street sell side, investment banking side, to use to price their derivatives so that they can figure out the arbitrage opportunities, okay? So I said, okay, so I knew nothing about stochastic process. Maybe I can just learn something about it, right? So my background is finance and economics. I learned math, I really like math, but nothing compared to Thalia's level. So I basically self-taught, the stochastic process stuff, but essentially competing against the physicists who are hired into those investment banks. Okay, so I'm utterly,
Everybody's
familiar
looking
with
at
all
Lisa.
this stochastic process, but still, it was more my drive to get into Wall Street to get a job, right? So that was during the time when there was an Asian financial crisis and the downfall of long-term capital. That was probably before many of you were born.
1998.
1998, thank you. So, long story short, I ended up working for academic for a really short time, having published 2 articles, and I just didn't feel much of that satisfaction. So I ended up going, into industry. But going into industry, I didn't end up going into an investment bank. So I, joined buy side and working on the quantitative research side. So on the buy side, back to Tanya's question, so we did look at a lot of the publications and research findings from the academic side as an inspiration, but really keep in mind all of the assumptions that were really used in developing that very elegant framework. But as Tanya said, there's very dirty reality, right? We need to solve a lot of things that cannot be assumed away. So hence, we needed to be very practical by saying, okay, so in fact, right now, in our credit, active equity, and active fixed income group, we use Merton's framework, right? But then that's our modified Merton with a lot of reality built in. So just give you a sense that really when the theory meets practice, it needs to take a lot of practical mind, and also just again, keep in mind of that translation, right? You got to think in the layman terms, think in Sam's world, right? When we, as an asset manager, we serve asset owners, right? So pension funds, endowments, basically keeping in mind that we are really responsible for all of these retirees, retired teachers, retired public employees, their retirement, their retirement, their well-being, post-retirement is in our hands. So we have to think very responsively. So with that in mind, we need to think about liquidity, once you have these very great trading strategies that seem to generate great, Sharpe ratio or information ratio, you keep in mind that if there's very high turnover, you would absolutely have to pay the transaction cost, and that simulated expected return may or may not materialize, right? So in our real world, we would say, other things being equal, we really wanted to make sure to reduce the turnover as much as we can. So that, again, that will come down to the practical part. Sam, I'm sure you have additional thoughts.
So I'll actually address the fiduciary thing, because I think you can see how, again, our panel is very diverse. It goes from theory to practitioner to asset owner. And my mindset is not one of mathematical finance. My mindset is exactly what Anjun said. It's a fiduciary mindset. I am responsible, the group that I work for is a fiduciary on behalf of the university. It's not my money, it's the university's money. And I'm responsible for making fiduciary decisions on behalf of the university. And that's extraordinary. It's an amazing amount of responsibility that is never meant to be just pawned off, right? You have to be very thoughtful about those decisions that you make. And so that is where the rubber really meets the road in terms of data that's clean and data that's dirty. And, would I hand over a data set, or would Anjun hand over a data set? Maybe. Some of the best quant funds that I know would never publish a paper because they don't want their secret sauce getting out, right? If you can make a couple extra basis points, or if you can make 20% a year, why would you give that to someone else? Why would you publish it? You wouldn't. So there's a fine line in, math and finance and investing for where data is clean, where it's dirty, what you publish, what you don't, what you keep secret, what you say in forums like this. So that's kind of an issue that is, I think, a tension between the theoretical side and the practitioner side, specifically for, for this type of industry, for the finance and investment industry. In terms of how clean is your data, I mean, I'll just give you a sense of the type of data that I see. Going back to the private equity funds, we get pricing on our private equity funds 4 times a year. That is not continuous. Right, so any stochastic process that you want to run that includes 4 data sets, 4 pieces of data a year, that's kind of a joke. We can all
hopefully you learned that those weren't enough data sets.
Yeah. I mean, law of large numbers, how many do you need? It's not 4. I'm like the jokester on this panel now. So, I mean, that's kind of what you have to think about in terms of the real world versus, in theory and practice, what actually ends up happening. And it's exactly to Thaleia's point, what sort of problems can you solve if you have 4 data points available a year? I don't know. I mean, there is a lot of judgment that goes on in my day-to-day job, and I'm probably one of the geekier people in the asset management business, just because I like geeky stuff. But so we talked a little bit about the use of judgment and maybe what it takes to be successful. So what do you guys think it takes to be successful in your role?
Well, in academia, and I'm sure this is true in practice as well, you go through different phases. At the beginning, when you are a young PhD, you need to be tenaciously technical. I think you have to prove that you know mathematics, you know how to work on tough mathematical problems, take risks in terms of how difficult the problem is and how innovative you can be in what you do. When you work in interdisciplinary research, as time goes on, judging from my personal experience, you get a bit tired of models that become more and more esoteric, and mathematics becomes more and more difficult. But then at the end of the day, when you ask the question, what does it really mean, and you have a very not very exciting answer, then you step back. And then you have two ways to go. You can either keep doing routine things within the academic world, or you can take risks and really sit back and try to understand what it all means. And then you realize that you need to come to a point where you can understand something stripped down to the bone, and you should be able to explain the most difficult technical thing in plain English. I think this is when you really, really understand what you are talking about. And when you want to build new models and introduce new concepts, you don't need mathematical sophistication. This will come much later, but you have to come to this point where you can explain it to someone who knows nothing about mathematics. And this takes time, but in my view, I think maturity in academia comes when you reach this point, and this is a long road, I think. Yeah.
So how often do you, go out and just sort of randomly explain math to people on the street in layman's terms?
I do it every now and then. I like talking a lot to high school students. I love talking about math and interdisciplinary research. This is something that fascinates me. So I think it's a lot of fun. Yeah. So that's the thing. Yeah.
What about you?
You're not going to quiz me for how to explain math, right? Probably can. So there are many ways to define success, and I'm actually looking at several very, very successful examples. And in academic, this is one of the really great, examples to be successful. In the practitioners world, there are also many different ways, right? I have many friends who just wanted to make money. So they will plug in a hedge fund working on high frequency trading. I actually have an extreme case where a couple of guys, one of them, a friend of mine, would use their own money to trade using their own money, right? So essentially they just sit in their study, with some powerful computer and trading platform. That's all they need. They don't need to go out and talk to clients. They don't need to worry about anything else. They just need to be successful doing whatever, and nobody's going to question them, right? They can do what kind of data mining to be successful in their mind. So they made money, they bought a big house, so they're happy. But broadly in the asset management industry, though, the way we are looking at, right, because we have a multi-asset research group that has over 20 very talented individuals. So when we look for people who are there and then looking for new people to join, there's okay, we could talk. Great. So we're going to look at 4 things primarily, So there's this concept called the SWAN, S-W-A-N. Each represents a desirable characteristic that we're looking for. So maybe I can just have a quiz of the audience. What does S stand for in your mind? Smart. And what about W?
Wishy-washy.
maybe the opposite of that.
Wise, witty.
Maybe wise, working hard. And then I'll skip that 8 and go to N. What does N stand for?
Nerd.
Ambitious.
So there's N, that's maybe nerdy, right? In the research place, we might need some nerdiness. And people need to be nice, right? So we got people who are smart. Some people say, oh, S can be strategic too. Okay, great. Strategic and smart. And you got W as wise and working hard. And you got N as in nice and maybe nerdy. And A as in, some people say analytical, but more importantly, she got it right, ambitious. So in my mind, there are so many people who are smart, who are diligent, who work hard, who are really nice, who are teamwork, right? Team, great team members. What differentiates that person from the crowd is ambition, how driven you are. If you want to get from point A to point B, whatever that point B is, you just need to set your goal, set the tactical steps, and get there. And that's where your drive will get you. No matter whether you come in, you don't know SAS, you don't know MATLAB, you don't know anything about it, like, econometrics, or not. Doesn't matter. You will find your way there. So that's a piece of advice from the industry, I suppose.
So I think it's especially in my seat, I think the use of judgment is incredibly important. You can have all the data that you want. You can know how to solve an equation. You know what the variables are that go into it. But where the rubber meets the road is really where you have to decide: are we going to go in this direction or that direction? And that's it can be wisdom, can be the W. But it's really about how you interpret the data that you're given and the solutions that you have on hand, if it's a math problem or if it's what you're looking at in the real world. So I think there's, eventually it's the decisions that you make and how that turns out over time. Are there other questions?
Well, I have one question I'm going to throw out to the panel, and then we'll turn it open to the audience. So one of the things about portfolio allocation, again, and just talking here on the buy side, I mentioned before, there's a whole field in the risk side of the equation in thinking about portfolio and construction. But much of this field originally, and how it was done by the asset owners and the people who delivered products to the asset owners, and even on the theory side, was created in a very different world than we have today. So we started off and we said, well, how are we going to think about the slices of the world? Well, we'll think about equities and fixed income, and we'll think about currencies, and later we added credit and timber and some other slices. Some people have 20 slices and some people have fewer slices. Much of that process was created in a world without the tremendous amount of technology and data sets and the ability to even think about things like robo-advising, or how do you construct and use more technology and much of what we've developed that's automated now to do some of the work. I wonder whether we aren't at sort of a renaissance period in the whole portfolio allocation and management world, where it will look very differently in not that many years as we unleash all of the great minds coming out of these programs and sort of pair with what's going on in fintech and in some of those areas, and whether or not it'll actually bring to bear more items that address how do you turn the tanker around to better, not just optimize to an efficient frontier for a particular data set, but for what the multitude of environments are that you face over these long time horizons. And one thing I'd be interested in hearing your thoughts on how much you see whether there's a renaissance and new exciting stuff, which I think will come at the intersection of academia and the practitioner world. And I'll just say for everybody out here, if you don't pick this area to go into, you will live this area, because demographics say that you will all live a long time. And as you live a long time, you will have to figure out, how much money am I going to put into my house? How much am I going to put into my retirement plan? What am I going to allocate in that retirement plan? Am I going to put it into stocks or bonds, or what am I going to be international? Am I going to be domestic? You're probably going to be helping your parents with that decision. My mom's 92. She's a brilliant investor, but we still have those discussions of how she should be allocating her investment dollars and what she should be doing. So you will eat, sleep, and breathe this, whether you go into it as a profession or not. But I personally think this is going to be one of the most exciting growth areas actually in financial mathematics. So I'd love your take on whether you think we're sort of at a point of change in how we're doing this.
I hope we're always at a point of change. I mean, I guess that can sound really hokey, but I mean, there's always people who are graduating, there's always people who are ambitious and driven, and there's, you know, always people with money to allocate. So be it in a venture capital firm, you know, if you want to go start a little company that does something, you know, robo-advising, as Tanya just said, you know, that's kind of always available. That capital cycle, you know, goes up and down at times. But I think in general, it takes longer than someone who is younger would want it to make changes to the world. And that's an unfortunate reality that I've realized over time. You know, you can be very driven and very hopeful, but it can sometimes take people who are 30, 40, 50, 60, 70, 80, 90, you know, time to get a new methodology or a new thought process in their head. So I hope that there will be lots of interesting changes and, you know, developments, but know that it will take time no matter what ends up coming up.
Yeah, so I do agree there's this almost structural change or mentality change. Post 2008, that was when I was a portfolio manager at Morgan Stanley. Every single CIO we talked to asked the same question. How should I think about my benchmark? What's my policy mix? You know, so in Sam's world, they would think about, is it 60-40? Is it some form of it that more diversified, including more private equity, more alternatives? Is that, would I solve the problem? Apparently 2008 showed that it didn't, right? There was still this very big drawdown. So as an asset owner and subsequently as an asset manager, we all concerned about that, right? So there was really literally a lot of soul searching, including myself, to think about how to solve this whole issue of benchmark versus active management, right? You manage against the 60-40s, you'll be judged and paid for your performance with respect to that benchmark. Post 2008, there's this a new trend that goes into this whole total return, what we call total return, or really holistic solutions for investors, not only for asset owners, but broadly for retirement, right? As Tanya was saying. So in our portfolio allocation world, we would need to literally coming down to that mean variance approach. Not just say, okay, so look at our active expected return versus the active risk, and you generate that information ratio, right, which is the risk-adjusted return vis-a-vis a benchmark. As opposed to right now, we're saying, hey, in the total return space, forget about the benchmark because the asset owners, our clients, and as also they rightly so, shouldn't be worried about defining some benchmark, having us underperform or outperform, hopefully outperform. But then the benchmark can have a problem, right? So we need to think about this whole benchmark. You might think about beta versus the active management, which is alpha. Sometimes we call it alpha, in a holistic fashion. So in our optimization process, we literally needed to take this portfolio expected return versus a portfolio risk and create some sensible optimized portfolio. So in my mind, that's really the beginning of a new trend of, the quest for solving that total outcome-based problem and creating some holistic solutions for retirees, for ourselves, and so on. So there is going to be a longer trend to that. So robo investing and robo asset allocation or advising is all part of this process.
Open for questions.
Yeah. I would like to add something that I was very happy to see that in the last, I would say, 3-4 years in mathematical finance, there is a lot of openness towards using data. Believe it or not, 5 years ago, 6 years ago, this was sort of it was beyond the royal duties of a theoretical mathematician. And you see a big change right now, and I think this is really great. And it's mostly the young people who are getting into data, and I believe this is a real change in my field. Yeah.
I would say that the next big change has to be getting out of your office
and
and talking to people. Right? It doesn't matter how shy you are. It doesn't matter how introverted you think you are or extroverted, you have to get out and you have to talk to people. I mean, even Thaleia said that's, the interdisciplinary problems are very interesting to her. Well, usually interdisciplinary means more than one.
I would like to give it will take a couple minutes. I would like to give a very concrete example. What is happening right now in my area in portfolio allocation? One of the you look at Markovich, and there's a lot of interest on the fact that if you look at Markovich from a theoretical point of view, in an abstract setting, in a finite horizon, then the dynamic policies that come out of the solution are not time consistent. Many of us are fascinated by this, and I plead guilty to that. So we have very nice papers looking at this time inconsistency. You talk to a practitioner, and believe me, they don't care less if the policies are time inconsistent. On the other hand, you talk to the practitioners and you say, well, at some point you will have to run a new optimization, quadratic optimization problem. You have to adjust your parameters. You have to put new inputs and move on. How do you do that? Is there a theory behind it? Why do you do this? Why do you do that? And I think the dialogue stops there.
So it's an important bridge to gap. We have a comment on that, yeah.
I'll wait for the mic. In the literature, I've seen lately more papers about multi-period optimization. And to me, it's been something that's been quite interesting because I imagine it's kind of a way that people are trying to bridge this gap between theory and practice. In theory, the optimization problem assumes you're trading your entire optimal portfolio every time you rebalance. However, as practitioners, we know that doesn't necessarily happen, and you may trade next week another portion of another optimal portfolio. How have you, in your own research, or perhaps your colleagues' research, had the opportunity to research multi-period optimization, and what are your thoughts? What kind of methodologies have you seen?
I've done zero research at the endowment, but I live multi-period optimization every month. And there's no formula that we use to get it done.
Yeah, so one is to maybe clarify what you mean by multi-period optimization. Like in the classical stochastic optimization problems, you rebalance continuously in time, depending on the market dynamics you have. I think if you look at what we have done in portfolio allocation, we always formulate the problem as an optimization problem. And there is very little on looking at performance of strategies. In my view, I think there's a lot of research to be done there. They don't need to be optimal for a very abstract expected utility problem. But I don't think we have put a lot of thought on evaluating performance of strategies, concentrating on these kind of problems.
Okay.
Yeah.
Yeah, so ideally that would be a great, big step toward being more practical. And we actually literally, went through some of these papers and tried to think about how we could incorporate it. The practical challenge is you have to think about that time varying and path dependent expected returns and risk and covariance matrix, right? That would ended up being, we're saying, well, that would be a great setup to do, but in practice, they will introduce more noise. So what actually ended up happening was to introduce, well, I always have that, but in a kind of as a bit of a trade-off, is to introduce, number one, a trading rule, which means you don't constantly or continuously rebalance. Every time you generate the new trades, you look at the expected return versus the cost, right? The trading cost, to gauge whether you should trade or not. In general, there's a rule of thumb, above a certain threshold you trade. The most liquid assets, the residuals remain in the portfolio till the model will tell you, hey, it's again, breaching enough so then you can trade again. So that's number one. Number two, from the portfolio manager's perspective, they would gauge the market impact of that trade, right? Even if it is breaching the trading rule, you wanted to say, well, is it optimal to trade in one shot, or we can pace it for the next few days? Or I can just sometimes opportunistically wait, because there will be a big announcement coming from Janet Yellen or someone from the Fed that can really could rattle the market however ways. You don't want to go into the trade facing that uncertainty. So then you wanted to, find a time when you feel more comfortable with that, what that market impact would be on the trade, then you go for it.
Other questions? Maybe you ladies can talk a little bit about what the roles are for young quants in this area. Like, what are the kind of people who you bring into your operation and you've seen in others, just so they have an idea of those positions?
Yeah, so I will start. In our, again, if it's a research role, we would prefer people who certainly would need to have some capabilities of manipulating the data. When I say manipulating, it's not any bad ways, right? To be able to take some spreadsheet, time series, to look at it, understanding patterns, and being able to program in a top-down world, maybe MATLAB, bottom-up, maybe SAS or something. But more importantly is the fundamental understanding of the financial markets and economics, and not just about what I've taken classes in Econ 101, Finance 203 or not, to understand the basics in book. So that's where I think it will be great to be able to do some internship so that you get a real life experience firsthand with that short period of time to see, one, what it takes to, what's required or demanded, and secondly, whether that's something you would like to do.
Yeah, I would say that if you want to become, if you're a young scientist and you want to become successful in mathematical finance, you really have to educate yourself very broadly. You need to take courses in finance, in economics. Definitely you need to have to go through an internship. This is not something that we promote in our programs, and I think it is a must. You really have to get out of the academic greenhouse and ask very different questions. This is a great plus for the research mind. I think this is vital in my view. Yeah.
So we hire people who are right out of undergrad. We like for our analysts to get their CFA, to understand some market knowledge, just basic market knowledge. We also hire senior analysts who generally worked at one other place before. Sometimes senior analysts will have their CFA already, or maybe an MBA, or like an advanced master's. The investment officer, managing director level, all of us are either have our MBAs or getting them. There's a couple CFAs thrown in there. There's the CQF, which is like the quant version of the CFA. And then there's our CIO, who has been a CIO before, and is really smart. So we hire people at different levels, different sort of background levels. We also have interns. We like to hire interns that can code. We don't have anything super fancy or exotic coding-wise in our office. We use Excel, and the basic language is VBA because everyone can basically use it. But that's sort of the skills and the type of people that we hire.
So does anybody have any other questions? If not, we can take any wrap-up comments and then we'll go to break.